I could call this the week of inflation, as it were, with the CPI numbers, the PPI numbers, something you've been warning about for some time. Now, some people are saying that shows sort of we've hit the peak, it's starting to come down. What did you read into those numbers?
You know, once again, the numbers were worse than people expected them to be. We may have hit a peak last month at 8.5, but we're not headed anywhere near 2 anytime soon. And that says that we've got very big challenges ahead of us in terms of managing this economy. And I think there's a lot of real risks out there. I see an overheated labor market as the core of the inflation process, driving service prices up. And I see lots of risks geopolitically in terms of supply chains, geopolitically in terms of commodity prices. And so I think this is going to be a very difficult environment for quite some time to come.
Well, let's talk about that quite some time to come, because we're now starting to see some people, including Jason Furman on Bloomberg earlier this week, say he thinks that we could have years of inflation. Even if we get a recession, we would, because there are some structural factors that could give us long inflation instead of long COVID.
Look, I think there are two sets of issues that mean that that is a plausible view. One is most inflations don't get stopped with a single slowdown. There are multiple attempts to break inflation before there's ultimate success. That was certainly the case in the previous big inflation that we've had in the modern era in the 1960s and 1970s. And then there's the argument, I'm never sure how much weight to give it, that we're probably in a more labor short economy that we used to be, that the pressures of globalization that we used to feel are no longer there, that there's more capacity of firms to niche market than there used to be, and that all of that means there's going to be a bit less ruthless deflationary pressure than we've seen in most of this century so far, and that could operate in the direction of higher inflation. I think I'd be very surprised if the average inflation rate during the 2020s wasn't materially higher than the average inflation rate during the decade of the teens. And it's reinforced by a growing number of voices. I'm not yet prepared to join the chorus saying that we should set a target for inflation that is higher than 2%. It could conceivably be ultimately right, but I think moving in that direction immediately would very much undermine what limited anti-inflation credibility the Fed has.
So, Larry, the question then obviously is, what do we do about this inflation? Is there anything that can be done? Obviously, the Federal Reserve has the frontline responsibility, but we also have the executive branch and now the legislature saying, well, we can do some things. We have President Biden saying to the FTC, take a look at price gouging. And then we have the Speaker of the House, Nancy Pelosi, saying she's going to bring legislation forward next week about price gouging at the pump. Is that going to help us?
The price gouging at the pump stuff, the more general price gouging stuff, is to economic science what President Trump's remarks about disinfectant in your veins was to medical science. It is dangerous nonsense. There is no material prospect that in any enduring way gouging legislation can have any substantial effect on inflationary pressure. But it can cause and contrive all kinds of shortages. It can distort a complex network of flows between crude and refined product. It can inhibit the supply responses that are what's ultimately the best way to overcome inflation. This gouging talk is a diversionary confusion. It's something that tends to happen when we have inflations, but we only make progress once we move through that and we understand that the real determinants of inflation have to do with the total level of demand that's being stimulated by policies. If politicians outside the Fed want to make a difference on inflation to the limited extent they can, they should be reducing tariffs, they should be letting more immigrants into the country, they should be reducing regulatory burdens like the Jones Act that mandates that only U.S. ships can take crude oil from Texas to the Northeast. They should be limiting demand by asking borrowers at a moment when they have a better financial condition than any time in a very long time to pay back their student debts rather than maintaining the moratorium. Those are the things that you can usefully do to influence the inflation rate. And all this gouging talk is a pandering diversion from all of that.
So, Larry, let's wrap up this week with a couple of quick rips from the headlines. One of them is cryptocurrencies and stablecoins. The prices of those certainly didn't go up this week. And in fact, I saw there was something like $270 billion worth of market value taken away. Do we know anything at the end of the week about cryptocurrency, stablecoin that we didn't know at the beginning of the week?
We've been reminded of something we should have known, which is that fear and greed drive financial markets, all financial markets, and crypto's not immune from that. And bank-run phenomena, whether it's banks, whether it's money market funds, whether it's repo, or whether it's crypto, when you don't have backing and you lose confidence, you get a big mess.
And finally, Larry, at the very end of the week on Friday, Elon Musk tweeted on the one hand that he was having some second thoughts about Twitter, and then he came back and said, no, he's still committed to it. It's not clear. The stock certainly went down, came back a little bit, but it certainly went down substantially. Does this say something larger about what's going on with tech right now? We saw that the value of so many big tech companies has come down. It's possible this is actually having some buyer's remorse.
Elon Musk is, I think, in some ways the Andrew Carnegie of our time. A titanic, innovative, driving, extraordinarily wealthy figure who, when he has leverage, uses it. And with the changes at Twitter that have already taken place, in the absence of other bidders, he has enormous leverage in this situation. And I suspect he's using it.
That's fascinating. The Andrew Carnegie of our time. That will go down. So, but as a larger issue, is tech not going to have as large a role in the markets going forward as it has in the past?
I suspect that the share of total wealth, total stock market that's in tech may be somewhat lower over the next few years than it has been over the last few years. But I think it's going to continue to be the case that the most valuable companies are tech companies. I think it's going to continue to be the case that, as it always is, that technology and the transformations that it brings are driving history. My guess is that we're going to see very profound changes coming out of artificial intelligence over the next decade, and I'm not sure where that's going to go.